Welcome to the Deep Dive, where we try to make sense of complex stuff and figure out what really matters.
Today, we're diving into Confluent's second quarter 2025 results.
Yeah.
And this one definitely caused a stir.
It really did. The call happened right after the U.S. market closed. And honestly, it presented this mix of good news and, well, concerning signals that left investors pretty divided.
Divided is a good word for it. Some saw reasons for optimism. Others clearly hit the sell button hard.
So our mission today is to unpack all of that. We want to get to the core of what was said, what the analysts are saying, and help you understand the key takeaways.
And it's fascinating because, when you first look at the numbers, the headline results, they look pretty solid. Actually,
Right.
quite strong.
Exactly. Let's start there. Their non-GAAP EPS, that's earnings per share adjusted for certain items.
Right. It gives you a clearer profit picture.
That came in at 9 cents, which actually beat the consensus estimate by a penny.
And even the standard GAAP EPS, that was also better than expected at negative 24 cents.
Mm-hmm.
So beats on both profitability metrics.
Then there's revenue, $282.3 million. That's up 20% from last year, and again, ahead of what analysts were predicting.
And the core of their business, subscriptions, that was up 21% to about $271 million.
Plus Confluent Cloud, which is a really key area everyone watches, that grew 28%. Hit $151 million. So solid growth there, too.
Definitely. And it wasn't just top-line growth. They showed some real muscle on the operations side, too. Non-GAAP operating margin hit 6.3%.
Which is a big jump, right? Like 570 basis points better year over year.
Huge jump. And significantly, adjusted free cash flow actually turned positive. $11 million positive, a 3.9% margin.
That's a milestone for a company like this, moving from burning cash to generating it.
It really is. Shows increasing financial discipline maturity.
Okay, and what about customers? Were they adding new ones?
They were. They added, almost 1,440 customers spending over $100,000 a year in ARR. That's up 10%.
So growing their high-value base.
Exactly. And the really big spenders, the $1 million plus ARR customers, they grew even faster, up 24% to 219.
Okay, so let's recap. They beat on earnings, beat on revenue, showed major margin improvement, flipped to positive free cash flow, and grew their biggest customer segments.
Sounds great on paper, doesn't it?
It really does. Which brings us to the big question you might be asking. Why on earth did the market react so negatively? It wasn't exactly cheering.
No, it certainly wasn't. And that is where this whole consumption conundrum, as some are calling it, comes into play. It's the heart of the matter.
Right. It's not about whether the Q2 numbers themselves were good, because they largely were. It's about the story behind those numbers and, crucially, the outlook.
Exactly. The nuance lies in the trends they're seeing with cloud consumption, especially among their largest clients.
And management was quite upfront about this. They talked about persistent optimization efforts.
Which basically means their big customers are finding ways to use Confluent Cloud more efficiently, maybe refining data pipelines, maybe archiving data.
Getting smarter about their usage, essentially. Doing more with less, maybe.
Precisely. Which is great for the customer's budget, but it means Confluent's revenue growth from that existing usage slows down, or even shrinks for certain workloads.
And the worry isn't just that it happened in Q2. It's that Confluent expects this elevated level of optimization, as they put it, to continue.
Yeah. Their forecast for the second half of the year explicitly projects cloud consumption growth to be notably below what they've seen historically. That definitely spooked investors.
And then there was this specific kind of bombshell announcement about one customer.
Yes, the marquee AI customer. That got a lot of attention.
They mentioned this large AI client is shifting some significant workloads away from Confluent Cloud towards their own self-managed internal platform.
Now, Confluent was quick to point out they did close a platform deal with this same customer, so they haven't lost them entirely. It's more a shift in how they're using Confluent.
But that specific shift is expected to hit Q4 cloud revenue growth by, low single digits?
That's right. And while it's just one customer, it's a big visible one, likely pushing the boundaries of AI. It raises questions about the build versus buy calculation for others.
It really does. It forces Confluent to constantly prove its value against potentially cheaper or at least more controllable internal solutions.
And you see the impact of this in metrics like net revenue retention, NRR. That dipped to 114%.
Which means while there's still growing revenue from existing customers overall, that expansion rate is slowing down. 113% is still decent, but it's lower than it has been.
Correct. And they also noted gross revenue retention, GRR, which measures just the retention excluding upsells, was marginally below 90%.
So a tiny bit more churn or downsell than perhaps ideal alongside that slower expansion. It paints a picture of cloud headwinds.
Definitely. So you have these clear short-term pressures, optimization, the AI customer shift, slightly softer retention metrics.
But, and this is the other side of the coin, the CEO was really emphatic about their long-term strategy, talking about becoming a complete data streaming platform.
And they're positioning for AI, particularly what they call agentic AI. They weren't just dwelling on the negatives, they highlighted some serious growth drivers, or green shoots.
Okay, let's dig into those. Apache Flink seems like a big one.
Huge one. Flink is their stream processing technology. They said its ARR, annual recurring revenue, tripled in just the last 2 quarters.
Tripled. Wow.
Yeah, approaching $10 million now. And it's split pretty evenly between their cloud and platform offerings.
So that really validates their move beyond just core Kafka,
Right.
expanding the platform's capabilities.
Absolutely. It makes building those real-time applications easier for customers and shows they're successfully moving up the stack in terms of value.
Okay, what else? Warpstream was mentioned too?
Right. Warpstream, this is their newer serverless Kafka replacement. Still early days, but they said Q2 business was mostly incremental, meaning new business.
And the economics sounded pretty wild.
They did. Customers adopting Warpstream apparently increased their total spend with Confluent by 30%.
Increased. But wasn't Warpstream supposed to be more efficient?
Exactly. They increased their Confluent spend while cutting their overall cloud infrastructure bill by about 50%.
Ah, okay. So it's a massive total cost of ownership TCO win for the customer. They pay Confluent a bit more for this specific service, but save a lot more on their general cloud compute and storage.
Precisely. It's a powerful value proposition, directly addressing those optimization pressures we talked about earlier.
That makes sense. It's a smart counter-narrative. What about partnerships?
Another big focus. They're putting serious money here, $200 million over 3 years, to expand their partner ecosystem.
Why such a big investment?
Well, they noted over 20% of their business in the past year came via partners. So they see a huge opportunity to scale that. They're launching new programs like for OEMs.
Original equipment manufacturers embedding Confluent.
Right. And an AI accelerator program. Plus, deepening ties with system integrators who help customers implement solutions. It's about broadening their reach significantly.
Makes sense. Leverage others to sell and implement, and AI kept coming up.
Constantly. They expect the number of production AI use cases running on Confluent to grow tenfold this year. Tenfold. Across hundreds of customers.
And they framed it not just as generative AI, but moving towards agentic AI.
Exactly. Where AI doesn't just create stuff, it takes actions autonomously. And that kind of AI needs real-time data streams, the kind Confluent provides, to function effectively. They see themselves as the backbone for that.
So positioning themselves as critical infrastructure for the next wave of AI.
That's the pitch. And related to that, they're also actively going after the native streaming services offered by the big cloud providers, the CSPs.
Like Kinesis on AWS or PubSub on Google Cloud.
Exactly those. And they're claiming really high win rates, well above 90%, with dozens of displacements just in Q2.
That's bold. Suggests their product and maybe that TCO story are resonating strongly even against the default cloud options.
It seems so. And internally, they're also making changes. There's a new chief revenue officer, Ryan McMahon.
And he's shaking things up.
Sounds like it. Improving sales coverage, building out specialist teams focused on the data streaming platform, or DSP. And apparently it's showing early results.
Oh, yeah. Like what?
They reported a 40% plus sequential increase in late-stage pipeline progression. So deals moving closer to closing, faster. Better sales execution, basically.
Okay, that's a positive internal signal.
And one more piece. Despite the short-term cloud usage adjustments, customers are apparently signing larger multi-year deals.
How do we know that?
Through their RPO remaining performance obligations. That grew 31%. RPO is basically the total contracted future revenue they have locked in.
Got it. So long-term commitments are still growing strongly, even if near-term consumption is bumpy.
That's the takeaway. A lot of positive strategic momentum happening beneath those cloud consumption headlines.
Okay, so let's talk guidance. What did they actually forecast? This is always key for the market reaction.
Right. For Q3, they're guiding to subscription revenue between $281 and $282 million. Non-GAAP EPS of 0.09 cent to $0.10, and about a 7% operating margin.
And for the full year?
Here's where it gets interesting. They actually raised the low end of their full-year subscription revenue guidance by $5 million. The new range is $1.105 billion to $1.110 billion.
True, they raised the floor despite the cloud concern.
Yes, and full-year non-GAAP EPS is expected around 4 to 6 cents, with roughly a 6% operating margin. So fundamentally, a beat-and-raise quarter, even with cautious commentary.
But there was a catch in the details, wasn't there, about the cloud mix?
There was. They signaled that cloud revenue as a percentage of total subscription revenue would be around 56% in Q3 and then dip slightly to 55% in Q4.
Not a huge drop, but it signals that cautious outlook on cloud consumption growth is baked into their forecast.
Exactly. Management is acknowledging that those optimization trends are likely to persist through year-end. They're being realistic or perhaps conservative.
Okay, so connecting all this back to the market reaction, which was, well, brutal.
Undeniably harsh. The stock dropped a bit after hours, like 2.2%, but then the next day in regular trading, it plunged almost 33%, fell to $17.73.
Ouch. And trading volume spiked.
7 times normal. And volatility on options, especially those deep out-of-the-money puts, just exploded up over 90%. Classic signs of panic or capitulation.
It really highlights that sentiment gap you mentioned. Management is telling a story of strategic progress, Flink exploding, margin expansion, AI opportunity.
While the market heard slowing cloud consumption and conservative guidance and basically hit the panic button.
Yeah, it seems like investors are incredibly sensitive to any slowdown in cloud growth right now. We saw similar reactions with stocks like Datadog and Elastic, right?
We did. There's definitely a cloud fatigue narrative playing out. Any sign of deceleration gets punished severely, sometimes regardless of the underlying reasons or other positive factors.
And what's the feeling from big investors, the buy side?
Reports suggest a quick shift to underweight positions. A lot of the long-only funds, the ones who typically hold for the long term, are saying they need to see proof. They want that consumption inflection point.
Evidence that cloud usage is picking back up again. Exactly. And the sell-side analysts, they reacted too. Downgrades, price target cuts, even though many acknowledged the strategic positives in their notes. The near-term story just dominated.
So what are people looking for now? What are the potential catalysts that could turn this around?
Well, number one is seeing that optimization trough maybe in Q4.
Yeah.
And having cloud consumption growth get back above, say, 30% year over year. That would be huge.
Okay, proof of reacceleration.
Also, the general availability of Warpstream, expected early 2026, landing a really big Flink deal, maybe the first $10 million plus contract, and continued margin improvements, especially if the sales mix shifts more towards the higher margin cloud offering over time.
So the challenge is clear. Confluent needs to prove it can get that top-line growth engine firing again, particularly in the cloud, without sacrificing the margin gains they've worked hard to achieve.
It's a balancing act, for sure.
Yeah.
Execute on this strategy while navigating these near-term headwinds.
Okay, let's shift gears slightly. This is not financial advice segment. Remember, we're just exploring ideas here, not making recommendations.
Absolutely. Purely hypothetical exploration.
So given that massive 33% drop after what was technically a beat and raise quarter, an outrageous yet plausible trade idea, some might ponder, is taking a strong, long position right now.
Potentially even using something like out-of-the-money call options dated out into early 2026.
Exactly. Going for leverage on a potential recovery. What's the thinking behind such a, let's be honest, bold move?
Well, the rationale would be that the market's reaction was an extreme overreaction. An emotional response, perhaps, to short-term noise, the cloud optimization, which management themselves called temporary.
All ignoring the strengthening long-term picture.
Precisely. You look at Flink, tripling ARR in 6 months, Warpstream delivering huge TCO savings and increasing Confluent spend, that $200 million partner investment aimed at scaling growth. These aren't small things.
They're foundational shifts, potentially, and the company did raise the low end of its full-year revenue guidance.
Right. Supported by the platform business strength and the promise of Flink and Warpstream. So the argument is, the market panicked about the cloud softness and ignored the accelerating growth elsewhere.
Now, those options would be expensive, right? With volatility spiking like that.
Definitely expensive. High implied volatility means high option premiums. But that also offers potentially outsized returns if those catalysts we talked about hit, like consumption reaccelerating or a big Flink deal or Warpstream GA.
Catching a potentially heavily shorted or under-owned stock off guard if sentiment shifts.
That would be the bet. A bet that the market's current focus on cloud optimization is myopic, short-sighted, and that it will eventually wake up to the broader data streaming platform story Confluent is building.
So the idea is that this huge drop isn't the beginning of the end, but maybe the inflection point, the buying opportunity long-term believers were waiting for. Again, purely a hypothetical trade concept.
A very contrarian one, given the current sentiment.
So wrapping this up, what really stands out from this whole discussion for you?
For me, it's just that stark tension. You have strong financials, clear strategic wins like Flink and Warpstream, and a compelling AI story.
Right, butting up against a market absolutely fixated on near-term cloud consumption trends and optimization headwinds. It's a real clash of narratives.
And the core question for anyone looking at Confluent now is, which narrative wins out? Will Flink, Warpstream, AI, and the partner push be enough to overcome this current cloud slowdown? Is this just a temporary pause or something more fundamental?
And maybe the most provocative thought to leave you with, could this brutal market reaction, this 33% drop, actually be the signal, the very inflection point that turns out to be a golden opportunity for those with a longer-term view? Something to think about.
Definitely food for thought.
Well, that concludes our deep dive into Confluent's Q2 call. Thanks for joining us and wading through the complexities.
Yeah, thanks for tuning in.